Do you know why internal audit is paramount to building long-term sustainable businesses? What is the internal audit? Internal audit provides independence assurance that an organization's risk management, governance and internal control processes are operating effectively. Internal auditing is an independent, objective assurance and consulting activity designed to add value and improve an organization's operations. Internal audit functions are often a catalyst for improving organizational governance and risk management. Internal audits deliver benefits that go far beyond regulatory compliance. Internal audit can help manage risk and evaluate a company's performance, and increase transparency and build stakeholder trust. Businesses in every industry can take advantage of internal audit. Internal auditors can save substantial amounts of organization money and protect its reputation in the marketplace by identifying operating inefficiencies, wasteful spending, employee theft, and non-compliance with laws and regulations. Internal auditors keep an eye on corporate climate and perform a variety of activities. Includes assessing risks, analyzing opportunities, suggesting improvements, promoting ethics, ensuring accuracy of records and financial statements, educating senior management and the board of directors on critical issues, investing fraud, detecting wasteful spending, raising red flags, recommending stronger controls, monitoring compliance with rules and regulations. The role of internal audit is to provide independent assurance that the following three pillars are operating effectively: risk management, governance, internal business processes. Risk management. Internal audit is primarily concerned with evaluating an organization's management of risk. All organizations face risks. The challenges brought on by the COVID-19 pandemic were a dramatic reminder of the impact that emerging risk can have on both local and global business operations. Internal auditing involves identifying the risks that could keep an organization from achieving its goals, making sure the organization's leaders know about these risks, and proactively recommending improvements to help reduce the risks. The key to an organization's success is to manage the risks effectively, provide advice on risk management practices, is the catalyst in forming risk management, actively participate in implementing risk management, provide independent assurance on risk management. Internal auditors' findings can play important roles in risk management. Effective risk management is not about predicting what will happen, but it is about being prepared for when challenges arise. Better tools can help. Data and analytics provide organizations with the capability to identify where threats are coming from and their potential impact on the business. It is critical to be able to navigate the realities of the fast-paced and highly connected business environment we operate in today. A holistic approach to managing risk can help create sustainable growth. It can help management achieve its business goals, enhance innovation, build credibility, and achieve business resilience. Who are the internal auditors? Internal auditors are explorers, analysts, problem solvers, and trusted advisors. Internal auditors bring objectivity and a variety of skills and expertise to the organization. They come from diverse areas, from finance, operations, information technology and engineering. People are often confusing internal auditors with external auditors. Let's discuss the main differences between internal and external auditors. Firstly, external auditors were appointed by shareholders or owners of the business. They report directly to them. There is a need for certain companies' financial statements to be audited by an independent external auditor, has been the cornerstone of confidence in the world's financial system. It assures that the management has presented a true and fair view of a company's financial performance and position. An audit underpins the trust and obligations of stewardship between those who manage the company and those who own it. Internal auditors typically worked for the company being audited. Internal audits perform consulting roles within the organization. They assess risks, evaluate internal controls, evaluate process performance, and identify deviations from management key performance indicators. Recommend process and control improvement to achieve organizational goals, assess business requirements and objectives, and make sure company compliance with applicable laws and regulations. External auditors are more focused on the accurate financial statement. External auditors are concerned with the accuracy of business accounts and the organization financial conditions. Internal auditors take a holistic view of their organization's governance, risk, and control systems. Internal auditors have a broad focus on risk management, corporate governance, organizational objectives and operational efficiency and effectiveness, compliance with laws and regulations. Internal auditors do not have to be certified public accountants. But internal auditors hold diverse backgrounds and skill sets include communication skills, data mining and analytics skills, information technology and business and industry-specific knowledge and accounting skills. But external auditors hold primarily accounting background and skills. The external auditor backwards-looking. The audit is focusing on historical information. Internal auditors are backwards-looking and forward-looking. Internal auditors need to be proactive and anticipatory to help businesses to gain and maintain a competitive advantage. Internal auditor takes a forward-looking approach and will alert the company to potential ways of building on its strengths and seeking new opportunities. Corporate governance. What is corporate governance? Corporate governance is the system by which companies are directed and controlled. The objectives of corporate governance are to ensure that the company's assets are used efficiently and productively and in the best interests of its shareholders and other stakeholders, to eliminate or mitigate conflicts of interest, particularly those between management and shareholders. The importance of good corporate governance. Shareholders own a business and they have their objectives. The day-to-day management and direction of companies are given to the board of directors. What shareholders like the directors to do in the business to ensure that shareholders' own objectives are met. But directors have their objectives too. Many shareholders are relatively passive, and the board of directors is given more or less rein to make whatever decisions they wish. What corporate governance does is ensure that the directors behave in such a way as to ensure the shareholders' objectives are met. Corporate governance is the cornerstone of any good business. It encompasses the processes, practices, and policies that a company relies on to make formal decisions and manage the business. Employing good corporate governance helps the company regulate risk and reduce the opportunity for corruption. Often scandals and fraud within a company become more likely where directors and senior management do not have to comply with a formal governance code. Good corporate governance ensures that the board of directors meet regularly, retain control over the business, and are clear in the division of their responsibilities, as well as maintaining a system of risk management. The benefits of good corporate governance. Corporate governance is all about making your business work better while abiding by the rules. Effective corporate governance fosters a culture of integrity. Good management is, of course, critical for the operation of a company. But managers need direction to prioritize operations and to allocate resources. It is the board of directors that is the principal agent for corporate governance. The board is given a mission by shareholders, translates that mission into specific elements of strategy, and then provides direction for management. Successful and sustainable businesses underpin our economy and society by providing employment and creating prosperity. To succeed in the long term, directors and the companies they lead need to build and maintain successful relationships with a wide range of stakeholders. These relationships will be successful and enduring if they are based on respect, trust, and mutual benefit. Accordingly, a company's culture should promote integrity and openness, value diversity, and be responsive to the views of shareholders and wider stakeholders. With a good corporate governance framework in place, supported by a healthy corporate culture, the organization should see a direct benefit. Risk is controlled, procedures are streamlined and consistent. The benefits of good corporate governance includes efficient processes. Due to repeatability and consistency of tasks. Visibility of errors. Repeatability and consistency quickly highlight non-conformities in the processes. Reduced costs. Repeatability and consistency eliminate waste from scrap, rework and other costly inefficiencies. The smooth running of operations and also compliance is assured. There will be more informative video to be uploaded on our channel. Make sure you subscribe and click the notification button bell to get ahead to the latest informative videos.